What's up, guys? My name's Michael, and welcome back to another episode of the Weekly Ticker, where I go over a stock and tell you guys whether it's a buy, sell, or hold. This episode, we're going over Costco. It has been declining significantly over the past year. It's declined around 10%. A lot of reasons, and I'll get into that. Before we jump into the analysis, definitely make sure to go check out my Discord. The link's down below. It's completely free. I go over news that'll affect you as an investor. I go over where the market currently sits, where I think it'll go in the future, my open and close trades, and much more. Definitely make sure to go check it out. So what the hell has been going on with Costco? Well, there's two main reasons. One is tariffs and one is valuation. Jumping into tariffs, just recently, Costco announced that they are suing the Trump administration over these tariff implications. They want a full refund for all the tariffs that were implemented. Costco stated that 1/3 of its U.S. sales are imported goods. These tariffs put some significant pressure on Costco, although they were able to soften the blow pretty significantly through supply chain adjustments as well as selective pricing. These tariffs definitely contributed to Costco not growing as strong as they wanted to. We'll see where this suing case eventually goes. Who knows? But Costco definitely got hit pretty hard by the tariffs, and this was shown in their stock price. Now, next is valuation. Costco is vastly overvalued. Its current PE is 48.7 times earnings. This is 17 times higher than the S&P 500 PE. Now, along with their vastly high PE ratio, there's a lot of other metrics that are showing that they are extremely overvalued right now. You can see their forward PE is 40.15 times, much higher than the S&P 500 forward PE. Their PEG ratio is a whopping 4.61, extremely high. Their price to books is 13.48, another overvaluation, and their price to free cash flow is 50.14. A lot of the other numbers are also overvalued, and this certainly was shown in the stock price, and investors aren't getting it at a discount, and they don't think that future growth is warranted for this extremely high valuation. Now, there's much more other factors that are contributing to Costco's decline in stock price over the past year, but those are the two big main reasons. Now, Costco does show very strong growth, as I'll show later in this video, as well as their fundamentals are pretty strong. Let's go into their fundamentals and see how they're doing. All right, so Costco has been able to increase their revenue pretty good. Nothing too crazy. They are a very mature company, so around 5%. In 2025, they saw a year-over-year growth in revenue of 8.17%. Really, 5% is the average. I mean, they have seen super good years, 15%, 17%, really seeing an average of 5%, which is strong. Now, Costco's revenue is split between two major factors: their net sales, that's them selling a physical product to someone, and then their membership fees, but the net sales are a large portion of their total revenue. Now, their net income has also been pretty strong. We can see that in 2025, they had a year-over-year growth in net income of 9.94%. So they're still showing signs of strength, even though their stock price is declining, as well as the tariffs that have, affected their profit margin. Now, if we look at their quarterly results for the revenue, we can see how the tariffs have actually kind of impacted them. We can see that in quarter one of 2025, they had a pretty big net income miss. They saw a decline in quarter over quarter of 23.62%, and they were not able to recover from that all the way till quarter three, where they saw a 6.43% increase. And in quarter four of 2025, they saw a very strong quarter, 37.15%. So we can see that, their net income has been declining, and this could be definitely due to the tariffs. Although they were able to really soften that, revenue was still increasing. They did a great job at adjusting their supply chain, as well as, changing around their pricing. So the main big feature of Costco is that they always have such a large portion of cash. 2025, their free cash flow was $7.84 billion. They hold on to a lot of cash. They have a lot of free cash flow. That's one good thing about Costco. 2024, they saw a slight decline in their free cash flow, 1.72%. But, they continuously have, super strong free cash flow. So a large portion of this free cash flow goes back to the investor in dividends. Their dividend is extremely strong. So Costco does pay out a special dividend every so often to their investors. With someone investing a lot of capital, this is a great dividend company. If you don't have a lot of capital, there's a lot better dividend plays. One of them is the Charles Schwab ETF. But in 2025, they paid out $4.92 per share for their dividend. This has been increasing from 2019 all the way to 2025, and it will continue to increase from the growth prospects that I will later show. Now, another sign of the impact on tariffs could be seen through their enterprise value. The market cap is always a good metric to look at, but the enterprise value is a little bit more stronger. It really shows the true size of the company when looking at their cash and their debt. Now, their enterprise value has been inclining from 2018 all the way to 2025, but currently they've seen a little bit of a decline. Despite the tariffs, their operating margin percentage has not actually declined, 3.88, and they've been able to increase this as well. In 2018, it was 3.21, so they've increased it by around 0.60. Their net margin is also super strong, 3.3%. Return on assets, 11.02, another strong number there. And their return on equity, 30.69%. Now, when looking at a retail company, you really want to look at their inventory turnover ratio. Costco has a really, really strong inventory turnover ratio, 13.05, so they're taking in a lot of inventory, selling it, and then restocking the shelves with new inventory. So for their Wall Street rating, their analyst consensus, out of 36 analysts in the past 90 days, 18 are saying a strong buy, 3 are saying buy, 14 are saying hold, 0 sell, and 1 strong sell. This is always important to take into your analysis. These big stocks and these big companies really move from financial institutions investing in them. Now the Wall Street consensus, the analyst breakdown, really shows you where Wall Street is, and really they're the ones moving these big large companies, so always important to note. Now in terms of growth, despite the stock declining, Costco's future or forward revenue growth sits at 7.88%. The sector median is 2.65%. This is a 196.91% difference to sector. And Costco's 5-year average for forward revenue growth is 8.82%. So they're still showing signs of strength through their forward revenue growth, and their revenue growth year over year is really strong, 8.17%. So Costco's been able to bring in a crowd of people, offer them a great product. Their business model is super strong. They pay out their employees great, so their employee retention is very, very, very high. And their revenue growth is super strong. So, despite the decline, their fundamentals still look super healthy. Now, their earnings per share diluted growth forward sits at 10.16%. Another strong factor there. And when we're seeing a EPS growth forward of a very positive number, 10.16%, we can expect that, their future earnings per share and their quarterly results will be very strong. So where does my consensus sit? I am not a financial investor, so take this with a grain of salt. This is for educational purposes only, but I really don't see Costco as a buy right now. Extremely overvalued. I really can't see it as a buy right now, given the extreme valuation. And with the maturity and the future growth of the company, holding long term, you're definitely going to see the price increase. But you're not getting this at a discount at all right now. Definitely, even with the decline in the stock price. I really want to see a lot of their valuation metrics come down a lot more and really be around that average of the market or where the S&P 500 sits, and then I can warrant it as a buy. Waiting for the valuation to come down and buying it will give you a much greater return than buying the company right now and holding it for 1 to 5 years. This is definitely a long-term investment, and if you do have a lot of capital and you're investing with a large portion of money, this is a great dividend stock. They pay out such a strong dividend. They always have strong free cash flow. They will continue to do so. Shit hits the fan, then they won't, but that's very, very unlikely. So yeah, there's a huge dividend stock depending on what your capital is. Thank you guys so much for watching this episode. I hope you learned something new. This series is something new that I'm doing. So every week you'll get, the weekly ticker where I go over a certain company. Yeah, drop your opinions down below. Definitely make sure to subscribe. Check out my Discord, like and comment, and I'll see you in the next episode.